Welcome to the September Economic Update. In this quarter's Economic Update, we're going to focus on North Korea. We're going to focus on some other media headlines, such as the Commonwealth Bank scandals you would have been reading about. We've got an update for you on Trump's America, and we also have a summary of the Australian reporting season. On the next slide, which is pretty busy, but you'll see that every investment decision, whether it be in a particular asset class or a particular investment, always involves aspects of the good, the bad and the ugly. And whether we go ahead and make investments in that asset class or in those particular investments depends on the summary that actually comes from focusing on each of these aspects. So for example, at the moment, there are very accommodative interest rates. It's the lowest interest rates ever. This makes a very good, positive environment to invest in business. Part of the bad aspects might include that we do think that interest rates now are about to rise. So we have been changing our investment strategies as we've moved through past economic updates, just recognising that in the future, interest rates and also correspondingly bond yields are going to be higher. So we need to factor that into our future investment making decisions, because we're always trying to invest with an outlook of about 18 to 36 months. Bad things that can come from that, or potentially ugly situations, might be if the world tries to adjust to higher interest rates and higher bond yields too quickly and there's not an orderly rebalancing. Many of these aspects we're going to visit in the upcoming slides. On the next slide, I think it's important to restate what our fundamental views are. So with the end of the era of cheap credit, some of the investments out there in the marketplace that have really benefited over the last 10 years by having extraordinary low interest rates will not be as beneficial for them in a rising interest rate environment. We also want to emphasise that the US is going so well. There's a lot of positivity coming out of the US right now. It's the biggest economy in the world, and it will be that locomotive engine that pulls the rest of the world along to it. And always keep in mind that markets will always overreact to particular media headlines. We're going to cover a few of those very soon, but with that overreaction, it actually spells for us opportunity in a very positive economic background that we're seeing out there. On the next slide, we're looking at some of our more tactical recommendations in the way that we advise you. The first thing is, in a rising interest rate environment, capital gains will be harder to come by. We need to moderate our expectations of capital returns down. And we cannot be complacent about some of the old school businesses, those blue chip businesses. They may not thrive in the upcoming environment. A good example we've touched upon in past economic updates has been Telstra. So in the recent reporting season in August, Telstra downgraded its dividend by 33%, which is not a good outcome in the short term for shareholders, but may actually be a good outcome some years down the track as Telstra reinvests in new business streams, new revenue streams. So there's future capital growth coming in that decision, but short term for shareholders, quite a large dividend cut. On the next slide, we're going to kick off with what you've been seeing a lot of media about. We just saw Donald Trump announce to the UN that, any more aggressive behaviour by Korea, he will go in. It's very important to look at what the actual situation is here, and I'm sort of fresh from a presentation on Sky Business News where I was talking about this morning. North Korea has not been to war for 60 years. So for the last 3 generations of dictators coming through North Korea, and all the saber rattling and the bluster and the tests, North Korea has not fought a war in 60 years. On the next slide, we summarise some of the salient points, really politically, that this is all about. China and Russia will not allow preemptive war on the Korean Peninsula. They've absolutely made statements to this effect. It's too close to home for them. I think the other thing that the world needs to come to terms with is North Korea is a nuclear power. North Korea is ballistic missile capable. Certainly China and Russia have come to accept this. They might not be particularly happy about it, but they've probably taken the view at this particular point in time there's nothing that they can do about. So for all the bluster, for all the sabre rattling, that sort of thing, the neighbours in the region, the large other nuclear powers, have accepted a nuclear North Korea. And the base case here that everyone needs to keep coming back to is that there will be bluster, there will be talk, there will be testing, there will be threats, but it is extremely unlikely that we move through to any war on the Korean Peninsula. That would have to be started by North Korea, which is something very unlikely. It goes against everything that they're trying to achieve. So base case is the same as the last 60 years. On the next slide, just a couple of quick what-if scenarios to go through. There have been trade sanctions levied. They've been heavily watered down by China and Russia. So to get them through, America was happy to accept those heavily watered down trade sanctions. But I do want to point out that trade sanctions against countries in the past by Iraq just found ways to get around the trade sanctions. They built a massive road through Jordan. They got their oil out of the port of Jordan. We think a similar thing will happen in North Korea. So the sanctions won't quite have the effect that the Western economies actually want it to have. On the next slide, no one's ever seen a nuclear bomb dropped on a particular country since 1945. So if one of the large countries, South Korea, Japan, if it's hit with a nuclear missile, all bets are off. The outcomes of the large great wars that we had really resulted in recession and depression. You take out very large economic trading blocks out of the world, you will cause recession and depression. But once again, it's not in anyone's base case, and you're talking a very small percentage here of an outcome like that. On the next slide, let's have a look at what's been going on in CBA. So CBA's had a financial planning scandal. It's also broken some of the AUSTRAC rules here in Australia. AUSTRAC rules, you must report deposits or withdrawals of more than $10,000. CBA has been in to report to us. They did say that they have implemented new software into their deposit-taking machines that didn't pick up these $10,000 transactions. The media has said there's been 59,000 breaches and that the fines for each breach is hundreds of thousands of dollars. CBA maintains that this one software mistake was one breach, but it was repeated 59,000 times. Those investigations will go on for some time. On the next slide, we can see that these announcements, this news and information, the CBA share price is in the blue. It's definitely lost that price leadership that it had in the Australian market. And we don't expect, with a lot of the ongoing investigations that'll take years to come about, probably 1 to 2 years, that it will regain that quickly. With that drop in price, CBA is back at the same valuation levels that the other three major banks are at. In terms of CBA profits, in terms of CBA dividends, there has been no effect. In terms of CBA's capital valuations that APRA monitors, there has been no change. Some very good questions that I had from some clients is, how does this affect my CBA fixed interest notes? On the next slide, it's very important to point out that while the CBA share price has dropped, the 4 other listed CBA fixed interest notes have not moved at all. This demonstrates a very important point with why you have an asset allocation that includes some shares, and that includes some fixed interest also. Fixed interest not moving in the face of an equity price decline is exactly what fixed interest is designed to do. It's there to protect your capital, it's there just to pay you an income, it's not a capital gain mechanism, but you can see by diversifying to a different asset class, the CBA notes, the CBA PCs, the PEs, the PDs and the PFs have maintained their position. With all this news and information, there's nothing that affects CBA's capitalisation, therefore there's nothing that affects its profitability, there's nothing that affects our distributions, and there's nothing that affects any of the clauses that would change CBA's mind about buying the notes back at $100 on the call date. Some people are a bit worried about the fines on CBA. I just want to let you know, in terms of valuation, we value banks on about 12 years of earnings. So if there's a fine in one particular year and those fines aren't going to be repeated, as we value a banking business out over the next 12 years, those fines don't appear. So there's not a valuation change. On the next slide, we're going to have a look back at the US and Trump's political agenda and his economic agenda. The next slide, which is a very busy slide, looks at the 4 aspects of what Trump has been trying to do and the policies he's looking forward. As an investor, particularly I am worried about its effect on the US economy, and you can see that that gets a large green tick. I really can't make any comments or statements about social policy or foreign policy. It's really the economic effect of what Trump is doing and how that actually drives business prices and how it actually affects things like fixed interest notes that we're concerned about. And certainly the lowering of personal taxes, the lowering of corporate taxes, the building of infrastructure and cutting back all the regulation and red tape holding business back, they are very, very positive economic effects. The only thing I'd add to this, and we have covered it in previous economic updates, but this legislation needs to pass through both houses in the US. And we think there will be some resistance there, only from the point of view that politicians will want to trade and negotiate things. Maybe they want a new highway in their state. Maybe they want a new hospital. So as they negotiate for these, they may delay the legislation, or they may vote no the first time around and then use some political horse trading to get what they want and allow the passage of it the next time. The US share market, we'll see in future slides, has done exceptionally well. And it's done exceptionally well because there is bipartisan support for a lot of this legislation to go through. But if the passage of that legislation is held up or slowed down or is voted no, expect a correction to come in the US share market. But just remember, once again, it's political horse trading. We do expect these positive things to go through, and we do expect that to reflect positively in the US share market. On the next slide, probably the other main point is that our forecasts for US corporates in terms of earnings, continue to grow up to a record high. So all these aspects particularly positive. Just be wary, corrections may come through with the passage of legislation, but US corporate earnings and the US economy, things are very positive. It's the locomotion engine of the world that will drag the other economies along. In the next slide, we'll have a quick wrap up of Australian reporting season. We've already discussed Telstra, we've already discussed CBA. In the next slide, this is just a quick summary. You probably won't be able to read this particularly well, but the main points that we picked up was things were very negative in telecommunications, and we've spoken before about the NBN data flow only going over the NBN and the cuts to telecommunication margins. That's what's going on there. We also saw reports in the healthcare and the aged care companies that came in below expectations. The market doesn't like that. In the outlook for a lot of healthcare stocks and in aged care stocks, they predicted flat earnings over the next year. And once again, that was a bit of a dampener on the share prices of those particular businesses. We would have ordinarily expected, just with the positive demographics, which are still out there, that these businesses would continue to see growing earnings each year. Certainly we think that will still be the case in 2019, but they did hose down those growth expectations just for next year. Some very positive reactions came through in some of the retail names that had probably been pretty unfairly beaten up coming into reporting season. And we also had some very positive reports out of mining. And we will walk through the commodity sector in a bit more detail a bit further on. In the next slide, excuse me, I just want to point out that the Australian market continues to be pretty choppy overall. The Australian market is at the same level as it was 3 years ago. In past economic updates, we've talked about being on the cusp between defensive bond-like proxies, income yield investments, and more cyclical growth investments. And we spoke about, as we get news and information that lean towards cyclical growth, as we get news and information that says we should be more defensive, that's what's caused this up and down choppiness. But by the time we get through to the end of this economic update, you should get a feeling the US is more positive, Europe is more positive. Both these economies are dragging along Asia. And we always said that Australia will feel this positivity with a lag. And we feel that lag is almost over. So we think there are some advances for our share market coming, but it may not be in the traditional market stalwarts that we've been used to being successful over the past 5 or 10 years. On the next slide, this just re-emphasises that point of where we are at in the economic cycle, but we really feel that this positive news coming through, that we really feel the central banks talking about rising interest rates to slow down economic activity is further evidence that we're about to go into the recovery cycle, which will favour more cyclical styles of businesses and will certainly more favour the equity market and shares. The next slide. Just wanted to make the point here that all major businesses during reporting season actually come in and directly report to us. We see them in front of us. They come into our morning meeting and they talk about their earnings and they talk about their future forecast earnings and the sorts of strategies that they're trying to do. Just picking some of the names sort of behind me there, Suncorp, Metway, Australian Pipeline Group, Challenger, Perpetual, they all come in and report to us. And that's very important, being able to eyeball management. And anyone in our 500 advisor network or our 60 analyst network or our economist can ask them questions about how their business is going, how their business is evolving, and how they're responding to some of the challenges we will think will come out, be thrown at them in the future. And this helps guide our investment decision making when we come through to creating strategies for you. On the next slide, just reiterating here once again the positivity that's coming through from some of the major economies out there. Economic growth, US, Europe, very strong. Industrial production picking up. Unemployment coming down. Inflation rising slightly, but certainly not out of control. We are seeing a great lot of positivity, and it's already showing in the US and the Euro economy, and it will come through to Australia with a lag, which we believe is almost over, and I'll show you why very soon. Just looking at the next slide. The last sort of points we just wanted to reiterate from previous economic updates. So we spoke about Telstra and some of the difficulties they were having. The black dotted lines you see in front of you, that's the day that Telstra reported. That's the day that Telstra cut its dividend by 33%, and you can see the share market reaction happening from that. In our model growth portfolios, we've been more looking at other telecommunication businesses like Superloop. It reported and had more of a positive reaction to what its future strategies were. Here we just want to reiterate further points from previous economic updates. So the share market has a very poor pricing mechanism in the short term, and we showed some examples with Livehire and Adairs, which I'll go through very shortly. Also, the Santos fear is very overdone. One of the largest recoveries from the 30th of June has actually been in Santos. The global economy is picking up, trade is picking up. We want to keep re-emphasising that point. That is behind a lot of the positivity that we're seeing out there. And Australia those benefits are going to come through very soon. The small cap, medium cap pricing of businesses in the Australian market, it's been very positive. There's been a very positive lift since 30th of June. US, China, Asia, commodity prices all continue to lift in response to the positive economic news that we're coming through. And the next interest rate rise that we feel will come through in the US will be in December of 2017. And then there'll be a lot more interest rate rises to come through in the US economy in 2018 and 2019. In the next slide, I promised to talk about those recoveries that we'd seen and how flawed the share market pricing mechanism is in the short term. So last time I gave you the example of Livehire, a Labor company float that we did. In the first 6 weeks of the float of this company, it came down 50%. Over the next 12 months, it rose up 400%. There was nothing wrong with this company, but the share price moved down for no explicable reason. You just need to remember in the short term, share market price is not value, share market price is not valuation, it's a voting system. It's a voting system of shares being sold and shares being bought. More buying than selling, the share price moves up. More selling than buying, the share price moves down. We also exampled Adairs, which is a betting company, which had suffered huge tax loss selling, particularly in the quarter between March and June of last year. And we said that there'd been a 47% jump in a single day. The second graph on the bottom right here is the Adairs share price since the middle of June, since we reported that. And it's actually recovered back in full. So just understand the share price pricing mechanism is particularly flawed. What you need to understand, and any emails that we send to you that have information only in the title, we're talking about the business. A share means you own a share of the business. So it's the business that's actually very important to you. It's the business that people will buy in the future. So when we update you on the business. Ignore the share price. That's like an attractive media headline news trying to grab your attention. What is fundamental is the business. And it's the business that people will pay for and buy in the future. On the next slide, just a few other examples there. You can see that this flawed pricing mechanism does happen over longer time frames as well. We've got Platinum there that was criticised for having bad performance in their funds. Kerr Nelson came into us and said, no, my value strategy here is good. The returns will come and the share price will And that's certainly what we've been seeing, especially since the 30th of June. Platinum's had a huge recovery. I've also put some of the share prices behind me on the listed investment companies. PM Global Capital at the bottom right did have a fall in share price and had a huge recovery. The share market pricing mechanism in the short term was leaving the share price more than 20% below where the net tangible asset backing was. We said be comfortable with this name, and it's come through and delivered. And certainly we've had similar experiences with some of the other listed investment companies like Cadence Capital, which is paying you a 10% grossed up yield per annum. And also the Contango Income Generator has been performing very well. It's almost come up 10%, and it's paying an 8.5% grossed up dividend yield, which we think is very attractive. So just be aware, share market pricing mechanism is flawed. It's all about the business. And that's what we'll keep reporting to you on. On the next slide, probably another example that I sent an email about was QBE. Whenever hurricanes or catastrophes are introduced, the market always gets concerned, and you see QBE fall to very attractive levels. But despite hurricanes coming through the US every year, we have seen an attractive recovery in the share price of QBE. What's important here, and this is what the email highlighted, in the last 4 years, QBE has doubled its dividend. It's increased the income that it pays to you by over 100%. And that is the business fundamental that we like about QBE, and we think that that will continue as bond yields continue to rise in the future. On the next slide, just covering off on what's happening in major global indices. You can see the US in the red there, Germany in the green, Japan in the brown. It's been a very positive environment. We just want to re-emphasise that. Australian share market in the blue has not participated as much, and we always said that the Australian economy will feel the pull from these other big economies with a lag effect, and certainly that's exactly what's happened. I did want to point out in the lower chart that over 3 years we have not seen much advance in the Australian share market at all. It is pretty flat, but the positivity is coming through, and we do think we will see those lifts very soon. The next slide. Here we just sort of analyse how is the pricing of big business going against the pricing of small business. That's what the lower chart's about. So the top 20 shares on the Australian bourse for the last 3 years, as shown in that bottom chart in the blue, is actually back. It's gone down by 5%. The clear winner has been those mid-cap businesses in the red, and you can see the small cap and micro businesses in the brown and green doing very well. And a lot of our listed investment companies focus in that mid-cap, small cap and micro cap sector. And that is where we feel that a lot of the continued growth will come through. In the top chart there, what I've done is I've actually graphed the Australian banks for you over the last 3 years. And their capital prices today, their share prices today, are exactly the same as they were 3 years ago. And they make up 35% of our index. Now, for investors seeking income, we are very happy with the banks. They are good income payers. For investors seeking a balance of income and growth, we pull back our weightings to the banks. For investors seeking growth, we pull back our weightings to the banks by quite a lot. In the next slide, I just want to re-emphasise here is that positivity comes through to Australia. You'll see the lower chart there. Smaller businesses perform better, and that was the US experience. So that's the Russell small cap indice in the US versus the larger cap indice in the States. So we will have that focus on those medium-sized businesses, those smaller businesses, as the next growth phase comes through and hits Australia. On the next slide, very, very positive things coming out of Europe. I can't emphasise enough that the policies being used by the European Central Bank and reported on by Mario Draghi are doing very well. We're seeing the strongest growth coming out of Europe that we've seen in a decade, and it's broadly spread across all countries. And we think that this will continue. They still are about 2 years behind the economic recovery in the States, but it is coming through. On the next slide, I want to look at Australian economies. So I've spoken about all of the economies around the world doing very well, positive news coming out, and the effect that that has had on commodity prices. Now, these are very long-term charts published by the Reserve Bank of Australia on commodities, and you can see the big base commodities, iron ore and coal, have had exceptional spikes, and that's part of the reason why some of our major miners reported such excellent income in the last reporting season. What that's actually done for Australia, though, is it's really lifted the terms of trade. And this is going to become important when we get around to focusing on the Australian economy. But before we leave commodities, just understand that further economic growth, further positive economic growth, is very good for the commodity base going forward. In the next slide, this is the chart where I show just how positive things are coming for the GDP for major nations. So Europe, Japan, the US all doing very well, and China and India having very strong growth as well. These will continue to pull commodity prices up and make them very strong. In the next slide, I now want to relate this back to what this means for the Australian economy. If you look at the charts, when the commodity prices peaked in 2011 and started coming down, there was quite a large drop in the terms of trade for Australia. And that meant businesses back here in this country were making less money. They were seeing their profits decline. Not every business is related to commodity, but it is the biggest exports that this company has. So transportation companies, service supply companies, logistics, there is a lot of businesses that are involved in making Australia one of the biggest export countries in the world. As those profits and things declined, business investment declined. And you can see the charts in the wage prices index there, both public and private, really moving down. Okay, since commodity prices really jumped up in 2016, business confidence at the moment is sitting around all-time high levels, even back up to where they were in 2006 and 2007. Business wants to invest. Investment means more jobs and more construction. More jobs, more construction means more people are being paid more, the country's being paid more, people start spending more, and then you get that positive cycling throughout the economy of people spending more. And I've covered that several times, how an extra dollar spent cycles its way through 9 times. So that positivity is coming through in business investment expectations. So that's why we think the growth in Australia is about to come through very soon. In the next slide, always important to touch on what's happening in fixed interest. Now, I've never done this before, but in the light grey there behind me, I've actually put what the UBS composite bond returns have been. Over the past year, they've been 2%. Over 2 or 3 years, maybe they've been 3%. If you've invested in fixed interest with us, you'll be sitting back and noting that we've actually given you returns in this sector that haven't been 20% or 30% more than what you see in front of you. They've been more like 200% and 300% more. This has been a very carefully thought out strategy that we've had for a long period of time. We knew that bond yields would start to rise. We knew the capital value of bonds and government bonds would start to move down, and we didn't want clients and investors exposed to that. We specifically chose floating rate note instruments. And that means when central banks tell us we're at the lowest interest rates ever, and those interest rates will rise, floating rate means as those interest rates go up, you get that benefit in your distributions straight away. And that's very exciting. On the next slide, you can see that in the floating rate notes that we've invested in, the capital lifts alone, going from $100 to $106 and $108, have actually beaten any returns before you even start to receive some of the distribution from these notes, which has been anywhere from 5.5% up to about 7%. This has been a very carefully thought out strategy that we've brought to you. And it's very important to understand that the returns that you have received in this sector have been hundreds of percent more than what people have experienced elsewhere. On the next slide, it's important to realise that part of that outperformance that you have received is due to the risk-reward nature of the notes that we have invested in. So the highest risk and reward that you can ever be is a shareholder. Business goes poorly, not only does the share price fall, but your dividend probably gets cut. Business does well, your share price goes up, and you can expect larger dividends going forward. If you're happy to be a shareholder, you should be comfortable taking a capital or hybrid note or a subordinated debt note from a particular business because you are safer in the investment structure. You are taking less risk, and we certainly saw that with CBA, with the share price falling, but the prices of the hybrid notes being extremely steady. The new offering that we had recently from Metric Credit Partners were in corporate bonds. This is senior unsecured debt around where the orange dot is sitting in this graph. I've always wanted to give you exposure to floating rate corporate bonds, but none were listed in any great volume on the market at all. This is the most secure lending that we can get to Australian corporates without having a mortgage over their assets like a bank would. So the Metric Credit Partners offering, which is the same as your other fixed interest notes, as interest rates rise, you will get the benefit of that straight away. So on the next slide here, just a few notes about that Metric offering that you received. This is corporate bonds. This is the most secure lending that we can give you exposure to. So we're really excited that the diversification that this offered you gave you exposure to corporate bonds, which sat in well with your portfolio of subordinated debt notes and your portfolio of capital hybrid notes. But please be aware, bond is the safest level you can take as a debt position. A little bit more risk, a little bit more interest payments, subordinated debt, a little bit more risk, a little bit more payments in capital and hybrid notes. Thank you very much for paying attention to today's economic update. Any questions, please email them through.